Today on Charged Alpha, we're covering Snap Inc., the company behind Snapchat, and one of the more fascinating and frustrating stories in social media.
Frustrating is the right word. Snap pioneered disappearing messages and vertical video. Every feature it invented, stories, reels, ephemeral content, got copied by Facebook almost immediately.
The company started as a Stanford student project in 2011 by Evan Spiegel and Bobby Murphy. The original idea was deceptively simple: photos that delete themselves after viewing.
That simplicity caught on fast, especially with teenagers. By 2013, Snap was processing over 400 million snaps per day, and Facebook came calling with a $3 billion acquisition offer.
Spiegel said no at age 23. That decision became one of the most talked about moments in startup history. In 2017, Snap went public on the NYSE, raising $3.5 billion.
On the business model, Snap is overwhelmingly an advertising business. About 87% of revenue comes from video ads, augmented reality placements, and sponsored content running inside Snapchat.
The remaining revenue comes from Snap Plus, a paid subscription tier, and hardware, the Spectacles AR glasses project that Spiegel has pushed as Snap's long-term bet on the AR layer for the world.
Gross margins run around 55%, which is notably lower than pure software companies. Server costs for handling billions of multimedia messages daily are a significant ongoing expense.
Competitively, Snap sits in a tough spot. Meta's Instagram Reels and TikTok dominate short video attention. Snap's advantage is its younger demographic, its strong AR lens ecosystem, and brand safety perception.
Snap's AR platform is genuinely differentiated. Over 300 million people use AR lenses daily. Brands from Nike to Pepsi use Snap's AR tools to let customers virtually try products before buying.
Geographically, Snap's reach extends well beyond North America. India is among its largest user markets by volume, and the Middle East shows some of the highest per-user engagement rates globally.
The monetization gap between those international users and North American users remains wide, though. Closing it is central to any bull case on Snap's revenue trajectory.
On leadership, Evan Spiegel has run Snap since day one, making him one of the longest-tenured founder CEOs in tech. His product instincts are strong. His execution on advertising infrastructure has been slower.
He stepped away from Stanford to build Snap full-time and has maintained creative control throughout. Snap's design-first identity, controversial interface choices and all, flows directly from his vision.
Snap has been narrowing its operating losses each year as it scales advertising revenue. The path to consistent profitability is the central question the market is pricing in.
One structural advantage Snap does have: its users are young. Advertisers pay a premium to reach the 18 to 34 cohort, and Snapchat indexes extremely high with that audience globally.
That profitability question gets stress-tested every earnings quarter. And speaking of which, Q1 2026 results have just landed, and there are specific numbers you need to know.
We break down Snap's quarterly earnings in the full episode, DAU trends, advertiser revenue per user, and what management said about the path to cash flow positive. That's coming up next.
Snap reported Q1 2026 earnings with revenue of $1.53 billion, up 12% year over year, and a GAAP EPS loss of 5 cents that beat the 7-cent loss estimate. Adjusted EBITDA surged to $233 million, more than doubling the $108 million from the prior year. Cautious Q2 guidance sent the stock down 7%. This is Charged Alpha. I'm Hudson.
And I'm Lana. Snap is the parent company of Snapchat, the messaging and social media platform built around ephemeral content, stories, and short-form video. Snapchat's core demographic is the 13 to 34 age group, with the highest penetration among Generation Z. The platform earns nearly all of its revenue from advertising served between stories, spotlight video, and the main discovery feed. Snap's augmented reality lenses and spectacles smart glasses represent long-term hardware bets beyond core advertising. Market cap is approximately $10 billion.
Evan Spiegel co-founded Snap in 2011 and has served as CEO since inception. Spiegel has led the company through significant layoff cycles, platform pivots, and intense competition from TikTok and Meta Reels. In 2026, Spiegel is executing on a path to sustainable adjusted profitability while maintaining Snapchat's relevance with the Generation Z and Alpha advertising audience.
Snap's Q1 2026 headline numbers show meaningful improvement in profitability metrics. Revenue of $1.53 billion grew 12% year over year, meeting consensus expectations. The GAAP EPS loss of 5 cents beat the 7-cent loss estimate by 2 cents. Adjusted EBITDA of $233 million more than doubled the $108 million from Q1 2025. A 116% year-over-year gain.
Daily active users reached 483 million in Q1, up 5% year over year. Monthly active users reached 956 million. These engagement metrics matter because Snap's advertising revenue per user is the key monetization lever, and improving DAU growth signals that the platform's relevance with younger demographics is recovering from prior periods of deceleration.
Free cash flow in Q1 was $286 million, more than doubling the $114 million from the prior year. Operating cash flow reached $327 million. These improvements confirm that adjusted EBITDA gains are translating into real cash generation, not accounting metrics. Snap's balance sheet holds approximately $3.2 billion in cash, providing operational runway.
AI-powered advertising tools are the primary revenue driver. Snap's direct response advertising platform has improved its machine learning targeting and conversion measurement capabilities, delivering better return on ad spend for advertisers. Higher advertiser ROAS means Snap can charge more per impression and attract a larger share of performance marketing budgets that have historically gone to Meta and Google first.
The cautious Q2 guidance is the source of the post-earnings stock decline. Snap cited the ending of its Perplexity AI content partnership and Middle East geopolitical uncertainty as factors weighing on near-term advertiser demand. While the Perplexity contribution was modest, the combination of guidance conservatism and a 7% stock drop post-earnings reflects how tightly the market grades Snap's execution against high expectations for the advertising recovery.
Full year 2025 revenue reached $5.93 billion, up 11% for the full year, with adjusted EBITDA of $689 million for the year. Q1 2026 extends that trajectory. If Snap maintains double-digit revenue growth and continues expanding adjusted EBITDA margins through the year, the full year 2026 profitability story becomes meaningfully stronger than the market currently prices.
The analyst community's reaction to Snap's Q1 results was cautiously constructive. The EBITDA beat and free cash flow improvement were the positives, confirming that the profitability improvement story management has been communicating is executing on schedule. The revenue missed to inline outcome and the cautious Q2 guidance are the negatives that kept price target revisions modest rather than aggressive.
Bulls who model Snap on adjusted EBITDA trajectory rather than GAAP earnings saw Q1 as confirming their thesis. At approximately $10 billion in market cap versus $689 million in full year 2025 adjusted EBITDA, the stock is trading at roughly 14 times trailing adjusted EBITDA, a valuation that looks reasonable if revenue growth and margin expansion continue through 2026.
The advertising market recovery is the macro tailwind analysts are modeling. As digital ad spending normalizes from 2023 softness and AI-powered performance marketing drives higher budget allocations to proven platforms, Snap's improving return on ad spend metrics position it to capture incremental budget. Analysts tracking click-through rates and conversion improvements from Snap's AI targeting tools cite early-stage but meaningful advertiser adoption gains.
The skeptical analyst view focuses on competitive displacement. Meta's Reels has captured a significant share of the short-form video advertising market, and Meta's advertising infrastructure, measurement tools, and audience targeting capabilities are substantially superior to Snap's. Bears who model Meta, continuing to take share from Snap in the performance marketing segment, see Snap's revenue growth as a cyclical recovery rather than a structural improvement.
The Q2 guidance cut is the near-term concern. Snap's history of guidance, beats, and misses has been inconsistent, and the Middle East uncertainty framing suggests management may be setting a conservative bar rather than facing genuine structural headwinds. How Q2 plays out relative to the conservative guide will be the key test of whether management's guidance credibility is improving.
The bull case for Snap centers on the EBITDA compounding trajectory. If Snap delivers 4 quarters of adjusted EBITDA at or above the $233 million Q1 pace, full year 2026 EBITDA would approach or exceed $1 billion, a threshold that would reframe the valuation from a loss-making social platform to a cash-generating media business. At $10 billion in market cap, that implies a sub-10 EV to EBITDA multiple.
The Generation Z demographic moat is Snap's durable asset. Snapchat has higher daily engagement among 13 to 24-year-olds than any other platform, a demographic that consumer brands and packaged goods companies are willing to pay premium CPMs to reach. As this cohort ages into higher spending power, Snap's demographic premium in advertising could expand rather than contract.
AI advertising tool improvement is a multi-year margin driver. Each improvement in Snap's direct response targeting and measurement capabilities increases advertiser willingness to pay more per impression, structurally expanding revenue per daily active user without needing aggressive DAU growth. This operating leverage path justifies a re-rating from the current trough valuation.
The bear case for Snap leads with competitive displacement by Meta. Instagram Reels and Facebook's short-form video offering have built advertising measurement and targeting tools that are significantly more mature than Snap's. Advertisers allocating performance marketing budgets follow return on ad spend, and if Meta's ROAS continues to outperform Snap's, the incremental digital ad dollar goes to Meta first, Snap second.
TikTok represents the user engagement threat. TikTok's algorithmically personalized short-form video feed has demonstrated superior user retention among the same Generation Z demographic. Snap serves. If TikTok resolves its regulatory uncertainty and continues U.S. market operations, Snap faces competition for the demographic segment that powers its advertising premium.
GAAP profitability remains elusive. Stock-based compensation inflates operating losses even as adjusted EBITDA improves. For Snap to achieve sustainable GAAP profitability, it would need to significantly moderate equity compensation, which risks talent retention in a competitive technology labor market. Bears who model SBC normalization as structurally difficult see the GAAP losses persisting even as EBITDA metrics improve.
User concentration risk adds to the concern. Snap's monetization is still disproportionately dependent on North American and European advertisers, with international daily active users generating meaningfully lower revenue per user. If mature market growth slows while international advertising monetization lags, the overall ARPU trajectory could disappoint the bull case timeline.
Meta Platforms is Snap's primary advertising peer and competitive threat. Meta's advertising revenue per user is approximately 5 times Snap's, driven by superior targeting, measurement infrastructure, and the scale of Facebook, Instagram, and WhatsApp. When Snap talks about closing the ROAS gap with Meta through AI advertising tools, analysts model how much of that gap is actually closable versus structural.
Pinterest is the closest peer in the social media with purchase intent advertising niche. Both Pinterest and Snap monetize through visual discovery advertising, and both have carved out defensible niches against Meta's dominance by serving specific consumer intent verticals. Pinterest's higher ARPU and positive GAAP earnings give it a financial profile that Snap is working toward.
Reddit is a newer peer in the social media advertising landscape, having gone public in 2024. Reddit's community-based content and search advertising positioning offers a different ad format from Snap's visual content, but both compete for incremental performance marketing budgets beyond Meta's core allocation. Reddit's faster revenue growth creates a headwind for Snap comparisons.
On valuation, Snap trades at a meaningful discount to Meta on both revenue and EBITDA multiples, reflecting Snap's lower margins, GAAP loss status, and slower user growth. The discount would compress if Snap delivers sustained EBITDA margin expansion and revenue growth acceleration through 2026. But the discount is structural without demonstrated GAAP profitability, not just a narrative gap.
Snap's options activity ahead of Q1 2026 earnings showed balanced put and call positioning, reflecting uncertainty about whether the EBITDA improvement story or the competitive pressure narrative would dominate the quarter. Pre-earnings implied volatility was elevated relative to the stock's recent range, typical for a small-cap social platform.
The post-earnings move, down 7%, was within the implied move range priced into options before the report. The Q2 guidance softness resolved event risk negatively in the near term. Options traders who had positioned for an upside move on the EBITDA beat saw that gain offset by the guidance-driven decline. The put-call ratio moved toward put-skewed positioning as investors bought near-term protection.
Insider activity at Snap is dominated by the co-founder equity positions. Evan Spiegel and Bobby Murphy hold significant portions of Snap's equity through Class C supervoting shares, giving the founders control over corporate direction regardless of public float trading. No notable open market purchases were reported in the most recent 90-day window. Multiple senior executive 10b5-1 plan sales reflect systematic diversification consistent with multi-year tenure.
The combined read from options and insider data is neutral. Options price the earnings reaction reasonably. The founder equity structure ensures Spiegel and Murphy retain strategic control regardless of stock price, reducing activist pressure risk while limiting accountability mechanisms that could accelerate a profitability pivot. For Snap, the thesis lives or dies with the advertising execution, not corporate governance.
Snap delivered Q1 2026 EBIT growth of 116% year-over-year. The profitability improvement story is advancing, but cautious Q2 guidance and competition from Meta create execution uncertainty.
Bottom line, Snap's adjusted EBITDA trajectory is the bull case. Meta and TikTok competition is the bear case. The stock's 7% post-earnings drop reflects a market still waiting for consistent guidance delivery before rewarding the profitability improvement with multiple expansion.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.